Welcome back to the deep dive. Today we are strapping into the driver's seat of a critical infrastructure giant, Bangkok Expressway and Metro PCL, or, BEM.
Right.
This is a company that, well, essentially holds the keys to moving one of Asia's largest and most congested cities. They manage core concessions for both major toll roads and the indispensable MRT rail network.
It really is the definition of an essential urban utility. And, on the surface, BEM should be the textbook example of a stable defensive stock.
It could be, yeah.
But the current landscape is, well, anything but simple. What makes this deep dive urgent right now is that tension between economic reality and strategic ambition. We're seeing fluctuating tourist numbers, local economic uncertainty, things pressing on their daily revenue.
Right.
And at the same time, BEM is launching into probably the most ambitious capital-intensive expansion phase in its entire history.
Exactly. BEM isn't just, sitting back on its steady revenue streams. They are making calculated, multi-decade bets.
Big bets.
They're balancing strategic, debt-heavy expansion, mostly focused on these massive future rail and expressway projects with the stable, predictable cash flow from their existing mature concessions.
Yeah.
So our mission today is clear. We need to move beyond the sort of short-term headlines, look at the Q20 2025 numbers to figure out the true current financial health, and critically identify and map out those long-term growth catalysts, the future S-curves, if you will.
Right.
The things that are set to drive this company's valuation over the next, say, 3 to 5 years.
And the foundational thesis for BEM, this informs pretty much every analyst's recommendation, is the strength of those long-term government-backed concessions. They create this unbreachable economic moat.
A moat, yeah.
But the crucial question for you as a listener is whether that moat is strong enough to absorb the cost of the strategic borrowing needed for these enormous new projects. We're looking for proof that the immediate financial pain of high debt will translate into exponential de-risk future value.
And as we move through this, just a quick note on the timelines. Our sources often reference the Thai Buddhist calendar year.
Right, good point.
So when we say 2568, we mean 2025. 2570 is 2027, and so on. We'll try to stick mainly to the Gregorian year for simplicity, but that gives you the context for the financial reports and the construction timelines.
They did.
Okay, let's dig into that Q 2025 financial report then. Despite the external turbulence we talked about, slow tourism recovery, general economic softness BEM actually showed a remarkable level of resilience.
They really did.
The headline net profit came in at 993 million Thai baht, which, interestingly, was incredibly close to the analyst consensus. They'd predicted about 995 million.
Yeah, pretty much spot on. And the stability here is really the story. That 993 million THB was largely stable year-over-year YoY, which is solid considering the headwinds.
Definitely.
However, it was up significantly, quarter-over-quarter, QoQ, about 14.2%. Now, while some of that QoQ jump is seasonal, more travel after the new year, the real takeaway is that the core business isn't shrinking. It's holding its ground.
And the total revenue kind of supported that view, right? It stood at 3,997 million THB.
That's right. Down only about 1% year-over-year.
Which isn't much given the circumstances.
Exactly. And that slight decrease really reveals the paradox of BEM's current environment. They held revenue steady despite some pretty significant external pressures. You mentioned the reduction in high-spending international tourists, especially from China.
Yeah, that was a big one.
A general tightening of the domestic economy, and more competitive travel options cropping up, ride-sharing, other transit extensions.
So the fact that profit didn't suffer significantly alongside that small revenue dip, that points to what? Good management.
Operational discipline, absolutely. The main driver of that profit resilience was strict, aggressive cost management across the board.
Okay.
And the standout detail here is their proactive debt strategy. Financial costs were actually reduced by a solid 5%.
5%?
Well, this isn't just passive cost cutting. It suggests BEM actively managed its debt portfolio, maybe refinancing older high-interest loans, or perhaps issuing new corporate bonds at more favorable rates.
Yeah.
That kind of discipline is really the only thing that sustains profitability when your core traffic volume dips, even slightly.
Okay, let's break down those revenue streams then, because BEM is really, like you said, a dual-engine company. How did the Super Cash Cow Expressway business, the toll roads, perform?
Right. This is BEM's established, mature segment, and it behaves pretty predictably. In Q2, the expressway business generated 2,084 million THB.
Okay.
This was a slight decrease, but 1% year over year, mirroring the overall revenue trend. Traffic volume averaged 1.08 million trips per day, down just slightly from 1.1 million trips per day, YoY.
So basically confirms its status as a mature utility. It's hit near peak capacity, highly sensitive to external stuff.
Exactly. Economic slowdown, construction, even a major accident, you see the volume move immediately. It's the stable anchor for sure, but definitely not where the future growth story is.
Got it. So that growth narrative belongs entirely to the rail business, the MRT system.
Correct. And here, the numbers, while they look modest on the surface, they hide that powerful operational efficiency story we just touched on.
Hey.
Rail revenue was 1,623 million THB, up only about 1% year over year.
1%, okay.
And ridership averaged 385,800 trips per day.
And here is where it gets really interesting. This is the big aha moment in the analysis, I think. Despite only a tiny 1% increase in revenue for rail, we saw this disproportionate massive jump in gross profit. One analyst report pinned it at a 54% increase.
54%.
That seems kind of crazy on just a 1% top-line gain. How on earth did BEM pull that off? What's the leverage there?
This is the perfect example of superior economies of scale in fixed infrastructure. Think about it. The operating costs for a rail line are largely fixed, right? Doesn't matter much if you run half-empty trains or packed ones.
Right, the base cost is there.
Exactly. And they managed to reduce their service costs by 2%.
Yeah.
Now, we can speculate how. Maybe tech upgrades, better train monitoring, smarter scheduling to save power, maybe better predictive maintenance, cutting downtime costs.
Okay.
When you have that fixed infrastructure, every extra passenger, even if it's just a few, and every single dollar you save on service costs drops almost straight to the gross profit line. It just magnifies the profit gain instantly.
Wow, that's a fantastic demonstration of management effectiveness, actually.
It really is.
And we also have to mention the inherent pricing power built into that core Blue Line contract. Analyst reports were citing that Blue Line revenue is still growing robustly, maybe around 7% growth.
That's right.
And that's entirely thanks to contractually mandated fare adjustments that kicked in last year in July 24.
Yeah, it's like a guaranteed escalator built right in.
Yeah.
That embedded contractual growth gives them long-term stability, regardless of short-term economic dips.
Okay, and just quickly, the commercial development side?
Yeah.
Retail, ads and stations.
That brought in about 290 million THB. Generally flat year over year, reliable supplementary income, nice to have, but the future really is rail and tolls.
Got it. So stability and operational efficiency define Q2, but we have to address the balance sheet. This is the cost of that future growth, right?
Exactly.
The standard ratios look okay for an infrastructure stock. PE around 21 times, PBV maybe 2.1x, dividend yield around 2.8%. But the debt to equity, the DE ratio, that's risen notably to 2.56x.
Yeah, and this DE increase is the point of nervousness. For some investors, we can't just gloss over it.
Right.
A 12% increase in total liabilities coming from net borrowing, that's up 14.6 billion THB in just 6 months. That looks aggressive on paper.
It does.
But analysts overwhelmingly are labeling this good debt.
Okay, why? Why do these big lenders and analysts see the substantial debt increase as good debt and not, a massive red flag?
It really boils down to two things: the strategic use of the funds and the underlying collateral. This borrowing is earmarked specifically for these massive, long-term, government-supported infrastructure projects, primarily that game-changing Orange Line we'll talk more about.
Right.
Financial institutions aren't lending against BEM's current earnings picture. They're lending against BEM's future concession assets. These assets guarantee strong, predictable, multi-decade cash flows. They essentially act as ultra-long-term, low-risk collateral.
Ah, okay. So the debt is basically secured by the future income stream.
Precisely. The debt is an essential prerequisite to actually securing and funding that next S-curve expansion. It reflects immense confidence, both from BEM and the lenders, in the company's long-term vision, all backed by solid government contracts.
Okay, moving from that current financial stability to the future. The strategic borrowing we just dissected, that's the fuel for BEM's multi-pronged S-curve strategy. Let's start with the base, the Blue Line, and its sort of foundational status.
Yeah, the Blue Line is absolutely the anchor. It hit its break-even point years ago. It now provides that consistent, predictable cash flow that supports the DE ratio we just discussed.
Mm-hmm.
And the critical factor here is its concession extension. It runs long-term, all the way to the year 2050.
2050, wow.
Yeah, that stability really solidifies its position as the bedrock S-curve. It guarantees revenue for the next, 25 years?
Okay. And building on that foundation is the Purple Line South extension. That's part of BEM's more immediate growth strategy, right? Our sources say it's progressing well.
Yeah, ahead of schedule, actually. Civil work was about 62% complete as of August 2025.
Good news.
It's slated for completion in 2027, with operations expected to start in 2028. And BEM is actively positioning itself to operate the entire Purple Line.
The whole thing.
The whole thing, under a PPP gross cost O&M contract, operation and maintenance.
Okay, what does that contract type mean in practice?
It's key. It means BEM is primarily paid a fixed fee by the government just for running the system. This insulates them quite a bit from ridership fluctuations. It effectively guarantees a return on their operational expertise.
Less risk then.
Much less risk on the revenue side. Securing the entire line would instantly create another substantial, stable S-curve for them.
Okay, but the undeniable game changer, the factor that seems to hold the most unrecognized value right now, that has to be the Orange Line project.
Oh, absolutely.
This project was stuck in legal battles for years, right? Preventing BEM from moving forward. But the recent legal clarity sounds transformative.
Absolutely transformative. The Supreme Administrative Court ruled definitively in favor of the MRTA, the Mass Rapid Transit Authority. That removed the last significant legal hurdle for the West Orange Line section.
Finally.
Yeah, this final ruling basically de-risks the entire project from a legal standpoint. Analysts are now confidently forecasting the official contract signing will happen either late this year, 2025, or maybe early 2026.
So it shifts from being this high-risk legal maybe to an actual executable high-certainty project.
Exactly. Huge difference in perception and valuation.
Let's talk about the scale of this rollout because it's massive and it's phased. The east segment, that's 22.5 kilometers long, civil work there is already complete.
Yep, done. They're targeting a commercial launch for that section in early 2028.
Okay, 2028. And the west segment?
That's a 13.4 kilometer extension, also actively moving forward. About 16% of the civil work is already completed there. Target commercial launch for the west section is July 2030.
2030, okay. Now, management seems realistic about the payback time. They're forecasting, what, 5 to 6 years after opening to reach break even?
That's their projection, yes. 5 to 6 years post-opening.
5 to 6 years. That's a pretty significant runway. Is the market comfortable with nearly a decade, potentially, of negative cash flow from such a massive investment, even with the long concession?
Well, the market generally accepts this for two main reasons. First, the very long-term payoff profile of these concessions, but maybe more importantly, the crucial synergy value.
Synergy value.
How so? This line is strategically critical because it connects directly with the already profitable Blue Line at the Cultural Center station.
The connection point.
Exactly. Think of it like adding a critical new spoke to an existing strong wheel. It's not just about the new ridership on the Orange Line itself.
So it feeds the existing network?
Precisely. It creates a massive network effect. The Orange Line taps into underserved areas, feeding substantial new ridership not only onto its own system, but accelerating growth across the entire rail network, particularly the profitable Blue Line.
Okay, that makes sense.
That acceleration of growth across the whole system is why analysts are so bullish. They're assigning a significant valuation upside just for the Orange Line alone. The range is somewhere between $1.35 to $2.5 per share.
Wow.
That suggests the current share price is potentially missing billions of BELT in future value that's tied directly to this project.
Okay, so that's the future of rail. Now let's flip to the other half of BEM's strategy, the expressway business. They're pursuing that big 35,000 million THB double-deck elevated expressway in Gumwon to Rama 9, right?
That's the one. 17 kilometers.
And the way BEM is funding this, it sounds like a stroke of corporate genius, frankly.
It really is a masterclass in leveraging an existing monopoly position. Instead of relying on the government for upfront capital, which is typical,
Right.
BEM proposed 100% self-funding of the construction costs.
Okay, so what's the catch? What do they get in return?
It's a simple trade. They asked for an extension on the concession periods of their most stable existing expressway segments, like that super cash cow Sai-Rat Expressway, by approximately 22 years and 5 months.
Wait, so they use the guaranteed future cash flow from their existing money printing assets
Exactly.
to finance the construction of the new asset? That guarantees decades of additional predictable cash flow without needing upfront government cash or burdening the debt market too much beyond the construction phase itself.
It's highly de-risked from a funding perspective and highly strategic. It basically trades short-term capital expenditure for guaranteed multi-decade concession extensions on already profitable routes.
Very smart.
Analysts certainly think so. They've already assigned a preliminary upside valuation of about 0.8 BART per share specifically to this double-deck project, just confirming its financial merit.
Okay. Before we move to valuation overall, we have to talk about the regulatory environment and operational risks tied to these massive projects. Specifically, those government policies aimed at reducing the cost of living, the fare caps.
Right, those are important factors. The first is the highly publicized flat fare policy, aiming for that 20 baht maximum fare across the rail network.
That sounds like a potential revenue hit for BEM.
On the surface, yes. But our sources confirm the regulatory position is pretty clear. If that flat fare is implemented, the government is contractually obligated and fully expected to compensate BEM for the entire revenue differential.
The whole difference.
The whole difference between the flat fare and the previously contracted fare schedule.
So the policy risk is kind of mitigated by guaranteed compensation, makes it largely revenue neutral in the short term.
In theory, yes, revenue neutral. However, the long-term operational impact needs watching. Well, the policy is likely to boost ridership dramatically, which is great long-term for network density. But it also significantly increases BEM's operating costs.
More trains, more staff.
Exactly. More frequent trains, more staffing, probably accelerated maintenance schedules. So while revenue gets compensated, the operational strain definitely increases. The long-term success really hinges on the timely and fair execution of that government compensation mechanism.
Makes sense. And similarly, there's the toll cap policy, aiming for a max of 50 baht for expressway tolls.
Yeah, similar idea. This involves BEM and Exit, the Expressway Authority of Thailand, basically renegotiating revenue sharing terms.
Okay.
The likely outcome seems to be a 50-50 split on certain mature segments, like the Siwat Expressway again. This policy might slightly dampen the peak revenue potential of the oldest assets, but it's generally viewed as more of a minor long-term adjustment, not a catastrophic risk.
Got it. Beyond regulation, there's always project execution risk, right?
Yeah.
These are gigantic construction projects.
Absolutely. Delays or cost overruns, especially on something as complex as the Orange Line or the double-deck structure, could severely impact the projected timelines and, crucially, reduce the internal rate of return, the IRR. That's probably the primary internal risk BEM faces right now.
And one last risk point, ESG. Environmental, social, governance. Any flags there?
Well, BEM generally scores well on governance. But the key social risk analysts consistently cite is travel safety, on both the expressways and the MRT.
Ah, okay.
Any major high-profile incident could severely impact public confidence, lead to reduced user volume. That creates a very real, tangible downside risk to all their traffic assumptions. It's something they have to manage constantly.
Okay, so given this strong strategic path forward, but also the immediate short-term economic softness in these risks, what are the investment pros actually saying? Let's look at the consensus recommendation from the IAA, the Investment Analysts Association.
Yeah, what's fascinating here is the sheer unanimity. The IAA consensus covers 15 leading brokerage firms.
15, okay.
And it's 100% bullish. That's 15 buy recommendations, 0 holds, and 0 sells.
Wow, 100% buy. That's rare.
It is. This consensus reflects a really profound belief in the long-term fundamentals and, importantly, the de-risking of those core growth projects we just discussed, especially the Orange Line. Analysts seem to view the current stock price less as a reflection of Q2 earnings and more as a temporary buying opportunity before that massive future value gets fully recognized.
Okay, but despite that 100% buy consensus, we see a pretty wide divergence in their specific price targets. That tells us analysts are making different assumptions, right?
Exactly. The 2025 fiscal year target price ranges from a conservative low of 7.30 Thai baht,
Okay.
all the way up to an aggressive high of 12.09 Thai baht. The average sits around 8.68 THB.
That's a big spread.
It perfectly captures the inherent complexity of valuing future concessions that aren't operational yet. The consensus agrees on the floor value provided by the existing cash cow business,
Right.
but they clearly disagree on things like how quickly Orange Line ridership will ramp up, or the final terms and certainty surrounding that double-deck extension. The more bullish analysts are fully baking in that, say, 2.5 BAT per share upside from the Orange Line right now.
This brings us to the valuation methodology itself. Why do analysts universally prefer the sum of the parts, or SOTP, valuation method for BEM? Why not a standard discounted cash flow, a DCF?
SOTP is pretty much essential for a company like BEM because fundamentally, it's a collection of distinct multi-decade concession assets, and they all have widely varying risk profiles.
Different risks for different parts.
Exactly. A standard single DCF model really struggles to capture that differential risk accurately. SOTP allows analysts to individually value each piece. First, the stable, mature cash flow assets, the existing expressway and the blue line.
Okay.
Second, the non-core assets, like their strategic investment portfolio in companies like TTW and CKP. InnovestX, for example, values those at roughly 0.8 BAPRs per share. And third, crucially, the highly strategic future growth projects, like the Orange Line and the Double Deck, they can apply separate risk-adjusted discount rates and cash flow projections to each of those.
So SOTP is necessary to stop this sort of short-term economic softness from unfairly dragging down the calculated value of those de-risked long-term contracts.
Precisely. The consensus view, putting it all together, is that the current market price has already discounted any short-term growth concerns, like the Q2 slowdown or any regulatory noise. But fundamentally, it has not yet priced in the future upside embedded in the now secured Orange Line and the likely double-deck projects. There's a clear, quantifiable upside gap that analysts expect to close once those contracts are officially signed and execution really begins.
Makes sense. Finally, for this section, let's look at the dividend profile. That's critical for a defensive infrastructure play like this. BEM paid an annualized dividend of 0.15 THB per share for the 2024 results, paid out earlier this year.
That's right. And that translates to a yield of about 2.80% based on the trailing 12 months, TTM.
Okay, 2.8%. Respectable.
And crucially, it's not just a static high yield, it's a growing yield. Their 5-year dividend growth rate is actually quite impressive, over 10.76%.
Oh, wow.
And the payout ratio looks sustainable, sitting somewhere between 59.4% and maybe 61.5%, depending on how you calculate it.
So how does BEM maintain this strong, growing dividend profile, even while they're taking on all this massive strategic debt for CapEx? Seems counterintuitive.
It goes right back to that super cash cow expressway business.
The anchor again.
Always. The steady, predictable, multi-decade cash flow generated by that mature expressway segment acts as an extremely reliable, constant engine. This stream of cash is large enough to effectively fuel both sides: internal growth, paying down operational costs and servicing that good debt, and guarantee robust shareholder returns through dividends. This dual stability makes the dividend highly reliable, even as the company moves into this heavy capital expenditure phase.
Okay, now for the final part. For a high-growth tech company, maybe we'd obsess over daily support and resistance levels on a chart. But for BEM, a company whose future is dictated by multi-decade concession periods, the long-term structural valuation trend seems far more telling.
I agree completely.
We need to look at how the market has historically valued BEM using those historical price-to-earnings, or PE, and price-to-book value, PBV, bands.
Right. And this chart analysis provides, I think, the final piece of evidence supporting that strong analyst buy consensus. Looking first at the historical PE band analysis. BEM's current forward PE for 2024 is sitting around 30 times earnings.
30x. Okay, how does that compare historically? If you look back over the company's operational history, that current PE seems significantly lower than BEM's long-term historical average PE. What was that average?
It was a robust 50.2 times earnings.
50 times? Wow. Why did BEM previously command such a premium PE multiple like that?
Well, BEM commanded that high multiple during previous periods of, let's call it, infrastructure optimism, specifically when the Blue Line extension was being finalized and, importantly, before the extended legal uncertainty surrounding the Orange Line really took hold.
Okay.
The market back then was pricing in maximum future growth potential and minimal regulatory friction. That 50x multiple was basically the market's recognition of a de-risked, high-growth infrastructure monopoly.
And today, where does that 30x multiple sit on the historical chart relative to the average?
It's a stark difference. The current PE multiple is much, much closer to the historical -1 standard deviation mark, which sits at 19.6 times.
-1 SD, okay.
What this implies is that, based purely on its own historical trading patterns, the market is currently giving BEM a valuation multiple that is far lower than usual. It suggests heavy discounting, likely due to those recent short-term economic concerns and the protracted legal battle, which, as we've said, is now resolved.
Okay, let's see if the price-to-book value, the PBV bands, confirm this view. That looks at valuation relative to the company's tangible assets. BEM's current PDV for 2024 is around 2.9 times book.
And again, this valuation metric is sitting noticeably below the long-term average, which is 3.6 times book.
Below average again.
In fact, the current PBV is actually near the historical -2 standard deviation mark, which is around 2.8x. Hitting the -2 standard deviation level is often seen as a classic sign of potentially deep undervaluation based on a stock's own historical benchmarks. It really suggests the market might be excessively factoring in short-term noise.
Okay, so synthesizing all that chart data, we get a pretty clear conclusion that seems to underpin that bullish analyst consensus.
Yeah, I think so. The market appears to be assigning BEM a valuation multiple that reflects significantly slower than average historical growth. It seems to be potentially over-reflecting the short-term economic concerns and the past regulatory and legal uncertainty. And crucially, it seems to be under-reflecting the massive, clear-cut growth potential embedded in those strategic Orange Line and Double Deck projects. These are projects transitioning from planning and litigation risk into active execution risk.
So the technical picture kind of confirms the fundamental story.
Exactly. The technical picture suggests the downside is probably well hedged by that stable cash cow-based business, while the upside potential from the future S-curves is significant and arguably currently underpriced by the market. Hashtag outro.
So we've taken a real deep dive into BEM today and seen a company defined by two powerful, almost contrasting forces. First, its exceptional defensive strength, provided by those existing long-term government concessions, that unbreachable economic moat you mentioned.
Right, the stability factor.
And second, its clear executable path for potentially exponential future growth via strategic investment in the Orange Line and Double Deck projects. These are now largely de-risked, legally speaking, and set to really change the financial trajectory of the company dramatically from, say, 2028 onwards.
Yeah, it's that rare combination of stability and targeted high upside growth that makes BEM such a compelling proposition for many analysts right now.
Okay, here is the final provocative thought for you, the listener, to maybe explore further as an investor, building on the network BEM controls. BEM currently holds a near monopoly over these vast physical infrastructure networks. But maybe more importantly, it controls massive, continuous streams of passenger data.
Interesting angle.
Where, when, and how millions of people commute daily. The next phase of value creation for BEM might not just come from simply increasing fares and tolls.
So what are you suggesting? What possibilities exist for BEM to fully leverage that huge amount of commuter data? Or maybe optimize its commercial development spaces further, like those increasingly artistic and integrated metro art stations they're developing?
Could they generate entirely new, non-fare revenue streams?
Could BEM transition from being just a utility company to becoming more of a smart infrastructure data platform? That integration of physical infrastructure and digital insight that could potentially create a completely new, untapped S-curve, something that goes far beyond traditional transportation services.
It's something to think about.
Yeah.
That is the knowledge you now possess for further exploration.